On this month's Alpha Money, interest rates and what does the math mean to you? 2 years ago, rates were at 0.25%. By July of 2023, they climbed to 5.5%, where they sit today. After 11 interest rate hikes over the last 2 years, there's been talk they'll drop 2 or 3 times this year. So let's turn to our Alpha Money expert, Mike Koyanen, who has been watching all the moves the Federal Reserve's been making to help you make the most of all of it. Mike, thank you for being here.
Always a pleasure to be here. Thank you.
So this seems to be good news. Let's start with first why that is when it comes to consumer loans and mortgage rates, Mike.
Yeah, for a lot of those, I'm not encouraging debt, of course, but for those who don't pay cash for cars or not in that ability to do that yet, for those who've been on the fence about buying a car because the interest rates are high for these consumer loans, these rates should be coming down and make it more favorable for those to buy the cars and an easier payment as well. Even for those who did buy cars the last few years when the interest rates were higher, when the Fed started dropping rates, there's going to be some opportunity to refinance that loan into a lower rate to pay off your car sooner or just get a lower rate as well. Along with that is credit card rates should be coming down as well to get that paid off. I don't like debt, so the key is get as much of that bad debt away as possible. Now we talk about some good debt, which is the housing market and mortgage interest rates. That's going to cause these rates to start coming down. And we're starting to see that already with the anticipation of the Feds dropping the interest rates. I just looked online here before we started, Liz, and interest rates between 6 and 7% on a 30-year rate, where they were up as high as 8 at one point, which has really halted the real estate purchase market. You talk to realtors, they've been pretty slow, not a lot of inventory out there. What this is going to cause is going to cause a little uptick in the market. We're going to see the housing prices rise again, probably this spring, summer, fall. People are going to be moving. First-time home buyers who have been holding off, including my children who've been wanting to buy a house, they decided not to this year and rent for another year because the rates were so high. They're going to step into their first-time house. People who are looking to upgrade their homes from one house to another didn't want to pay these outrageous interest rates. So we're going to see that happening as well. So for those who are on the fence and we see this coming, get your house ready. Get ready for that anticipation. This might be the season to upgrade your home or get into that first home.
And now the mixed bag here, Mike, and that's CDs and money market accounts. What should people do there?
The good part of these high interest rates have been banks have been paying you something. Before it used to be 0 point nothing, and now you're getting 4 to 5% on these CDs or high yield savings accounts, money market accounts. But as these CDs are coming due, good opportunity to renew them before rates really drop, because we don't know where the rates will be in a year. Most likely, maybe at 1, maybe 1.5%, 2% lower, especially in 2 years. We might be back to where we were a couple of years ago at a 1-year CD at 1.5%, 1.75. So it doesn't really pay a lot. So now's an opportunity to renew those in time. There are some still online banks that'll pay that are FDIC insured that'll pay you over 5% on a high yield savings. Or else you could look at something like a fixed annuity that can lock it up for 3 to 5 years. Pay is a little bit better than banks, 5 to 5.75. I've seen these rates for a 3 to 5 year fixed account. So opportunity to lock that money in while rates are still high.
So don't let them sit there. Go ahead and reevaluate to figure things out moving forward.
Exactly, because a lot of times these renewal rates that the banks will send these letters, those renewal rates aren't that great. And you have to really shop around and find that best rate at maybe a different bank, unfortunately.
So let's take out the crystal ball here. Final question. Where do you see things when it comes to the overall market, Mike?
The investors are actually anticipating good things. And we've seen that since end of October of 2023 till today, the market's up over 18%. When we talk about the market, we're saying the S&P 500 index is up over 18%. We have had a nice rise in the market. There's a lot of investor confidence in the market of the Fed saying, you know what, we're done raising rates. That came out in December, which has helped the markets. Now the anticipation with the Fed's meeting in March that they're going to be dropping the rates has helped the markets as well. You know, economists said we're going to break through 5,000 on the S&P 500. We're almost there today as we speak right now, just a few points behind that. So we're easily going to break through that, most likely, I should say. But when the Fed start dropping the rates, that'll help confidence, it'll create spending in the market, which will help the markets as well. But even for those who held on to bonds, now we're talking about the bond market is different. People have taken a beating in the bonds the last 2 years. We've seen people lose anywhere from 12% to 25% in bonds. And now, because they're interest rate sensitive, when the Feds raise rates 11 times, bond values lost. And now when the Feds start dropping rates, bond values will climb back up. You're not going to see the spikes like we see in the equity markets in the bonds, but you're going to see some recovery in those as well. And if you haven't been in bonds, now might be the opportunity to get back into them because of the interest rates coming back down.
Mike Koinen with Principal Preservation Services with great advice on interest rates and what they mean for you. Again, Mike, thank you.
Thank you, Liz. I appreciate it.